My best syndications that I've invested in are triple net leases. Absolute best, because they are performing really well. There was
I
not.
hope you don't have any Walgreens in there.
Huh?
I hope you don't have any
I
Walgreens
do
in there.
not.
Can you? I don't know why that's funny.
They're
I don't
they're
either,
they're,
really.
they're closing a bunch of stores.
Really?
A lot. When I got into this industry, Walgreens was the golden goose. If you bought a triple net Walgreens, that's as good as a U.S. Treasury. Cap rates for them was like some of the lowest. Now I'm seeing them trade in the 8% cap rates just because they've been shutting like 10% or so down of their stores for the past few years, and it's just, there's not really an end to that trend in sight.
And if you go back to when all the old Eckerd's drugstores went out of business, are you old enough to remember that?
I wasn't until you said it, and then I had a flashback of like, I know that for some
It was
reason.
blue logo and all that.
Yeah.
Well, there was about a 10-year period of there where, about every 10 or 15 blocks you drive through a suburb, there'd be a vacant Eckerd's building just sitting there. And that's kind of what these Walgreens and CVS.
Well, what's crazy is Walgreens will have a 15-year lease paying $250,000 a year, and they'll vacate it. They'll just let it sit empty. I don't know their full strategy behind it, but I know some brokers who specialize in the drugstore space, and they have lists of hundreds of locations where they've got 10, 11 years of term, and you basically sell it at that point. It's just the value of that annuity plus dirt.
Because it's a corporate tenant.
Yeah.
You're going to get paid.
You're going to get paid.
I've never
Unless they
understood
go
that
BK.
though, because there's an old Albertsons in Uptown. Hadn't been to Albertsons in like at least 5, maybe even 10 years. I don't even know the perception. It's been a while since it's closed, but I guess because it's so damn expensive to be there, there hasn't been a new tenant. And I just don't understand why this prime real estate is sitting empty in the heart of Uptown.
It's usually the other operating costs or the other costs of occupancy. So, I mean, if you have your doors open, you got to pay insurance.
Mm-hmm.
What are your utilities? What is the cost of employment? It's those other things where you look at that versus if you close the doors, you pay your basic property insurance and rent. That's the calculus. At least
So it's
for
going to be a
who it
loss,
was.
or it's either a small loss and do nothing, or potentially bigger loss and then have a lot more headache.
Yeah.
Well, I'll put it like this. I mean, so if you think about some of the short-term rental properties that residential investors have, the one that Jennifer and I have, we do a lot of temporary midterm housing in it. But if we were to turn off the utilities, and that's, by the way, that's electric, water, sewer, TV, yard service, probably still have to pay that, but maybe not water the grass. Our base operating cost for a vacant structure on that home is about $1,100. It's about $2,500 if we have it in service. So mathematically, that's small, relatable residential numbers, and just 10 or 15x that over there, and that's the decision.
The other issue for Walgreens, and Family Dollar is recently going through this too, post-merger. With Walgreens, they were actually ordered to shut down some stores to prevent when they purchased Rite Aid. Part of that was anti-competition. They had to shut some stores, but then also it's not uncommon to stand on one corner, see a Walgreens, and see a Rite Aid right there. So I mean, if you're within a block, you can't have two stores in that market. So it's cheaper at that point to just shut it down. Make it a Spirit Halloween store periodically.
Right. Well, I mean, I'm very familiar with the idea of sunk cost. So
Yeah.
that's what it is.
Yeah.
Well, the whole bid-ask thing, right? It also comes from, in residential, a lot of people normally think in terms of ARV, right?
Right.
And
That one I can talk about.
yeah. Well, if you really think about it, it's a yield. You've got X dollars invested in it, and you make Y in net income, right? And you've got a yield. And so if you were to sell that and take your equity, now your yield on that equity changes. Your return on your equity changes. Now, right now, with rates doing what they're doing, it's pretty easy to get a money market to give you 5%, which is better than a 4 cap. But you recoup some depreciation expenses. So typically they want to go place it into another project. Well, the problem is right now is if they can't sell this on a 6, or if they can't sell this on a 4 and they have to sell it on a 6, they're just going to go buy another 6. Why the transaction cost? Unless you really just have to buy a bigger asset. Now I think some of that will help when we get 100% bonus depreciation back, which surely is coming soon.
Knock on wood.
Oh, it's that's going to be.
That's got to come back.
Well, Daddy Trump is a real estate guy.
So Daddy Trump's a real estate guy that needs inflation to continue going up.
That was the other thing I was going to say is it should help us out after this year is they got to redo the tax code.
Yeah.
It expires this year, so that they and I'm betting that 100% depreciation is going to come back.
Yeah, and that's a silver bullet that they'll save for comprehensive reform. And I would imagine they'll try to codify that into permanent tax code. Specifically, since if Trump believes that his children will continue the enterprise, there's nothing better for a commercial developer than the bonus depreciation rules.
Yeah. It incentivizes transactions, which is overall good for the economy.
I agree. I mean, especially since I haven't paid taxes in like 5 years.
Legally.
No, yeah, like I file taxes. I just don't have to pay.
Yeah.
That's the complicated thing on the finance side right now is people want money, but their returns are low and the inventory is limited and comps are limited. And so we're always trying to make common sense lending decisions. And since we loan our own money, like I'm not driven by some Wall Street hedge fund or some big, thick underwriting guideline book. It's Tim Harridge and his experience buying houses trying to be consistent.